50 points now on the index. Prakash Dewan is with us and so is Rohit Srivastava of Indiacharts. Gentlemen, good afternoon. Good to have both of you here. Rohit, if I can start by sort of coming to you first. So, big damage yesterday, big recovery today. And we were just chatting Friday to now. Actually, we're now up about 40 points. Friday to the current market price. So it's decent. I mean, actually, Monday and yesterday, you can almost, I don't know if you can kind of describe it as a head fake, but that basically is what it's turned out to be. What's your sense? What's the trajectory from here likely? And just your thoughts. Go on.
I wouldn't call it a head fake. All these moves are happening on some extreme sentimental behavior that has got created. A lot of it got created by the first the entire flow that you're going to get a win in one direction. So markets were rallying for several months. And then somewhere doubts emerged and you had a huge short positioning that developed ahead of the election results, which caused many spikes on the upside, as in when you got positive news. And then when the news is not so positive, I'll not say it's negative because it's not, you got a downward spike, right? So this volatility is just being created by positioning. Even the sell-off yesterday also got triggered because a lot of people on Monday ended up, especially the short-term traders, those who are on margin, ended up buying a lot, expecting that this was a runaway move, and then it resulted in a lot of margin calls. So that is the nutshell what has happened. But you put it in perspective, the overall trend of the market has not been damaged by whatever has happened in 2 days. Like you said, if we go to a weekly chart and all this up and down moves are just highs and lows, eventually you end up closing in the same range which you were for so many weeks. So then it tells you that, okay, you went nowhere. You still need a breakout of this, to move ahead. So we'll continue to look for that. In the short term, though, the VIX is very, very high. So I sense that somewhere markets do need to consolidate some more. I don't think they can just run away one way. I think large part of today's bounce is that short covering again because there was extreme selling yesterday. And so again, you have, buying causing a bounce. Is it a complete reversal? No, but the lows might be made. So I would expect first some consolidation here. For example, you retraced almost 66% of the 2-day fall from the high to low, which is at around 22,645. So somewhere in this range, sense you can get some selling again, to close out some of those losses that have still happened in the PSU space. If not, also you need the VIX to really come down because you usually don't get sustained rallies, at a 30, 20 kind of VIX, the kind of levels we are at. I think VIX will eventually come and settle back at around 15. So I would give markets a few days to consolidate, but eventually head higher. That is how I'm thinking about it. That means the trend is up. It's just that the volatility needs to cool down. You don't really get, you can't keep going on 500 points every day, which is not the normal behavior of the market. So that is something people should not anticipate, especially short-term traders should not anticipate that tomorrow will be another 500, 700 point day. That is not going to happen. But you will eventually head higher. So it is a buy the dip market still. And you'll have to make sectoral shifts in terms of where you want to be so that you avoid being in the wrong places.
Rohit, hi, afternoon. I think you partially answered that question because you pull up the 1-year chart of the Nifty and that tells you all the up and down and the buying and the selling, and then yes, we've had this major move in mid caps, etc. At the aggregate index level, index is up what 4-5%. I mean, not even 5. I think 4% for the year. The bulk of this 21% move that happened actually last year, calendar year. We've not done much. So considering, if I could call it, continuing slightly upward consolidation from here onwards, now I'm asking you actually for a 6-month view, not an immediate view. I mean, let's say by the end of this year, are you expecting the possibility of, that up move, a bigger up move continuing? Or do you think this is going to be more of a ranging market where you're better off putting money in individual stocks to work rather than expecting index level pop? What would you say over here?
So I don't know whether I should give you a level or I should give you the thesis first.
Both.
So I'll start with the thesis. Okay, the thesis is this election is over. We have a party that is going to form the government. And that means you're getting continuity and stability both. It doesn't matter that it is a coalition or not. That doesn't really change the growth perspective, and that we've seen in the 2004 episode. So that doesn't need to be, relived. So such panic scenarios end up therefore being opportunities to, buy at certain levels. It also relieves some of the overbought status of some of the individual stocks and sectors. Now, how does it move forward from here? So one thing is, okay, you got stable government, that's out of the way. Earnings growth was already there. There is some slowing in earnings growth. I think the key trigger there is going to be interest rates. I think interest rates in India are going to come down a lot, not just a bit. The bond yield, which was already below 7%, till day before, did spike up yesterday. I think once it gets back on track in line with what global bond markets are already indicating, you will see bond yields in India go probably even sub 6% again. So I think interest rates are going to get cut at some point of time, hopefully sooner than later, because the government has become fiscally prudent in the last year, as you saw in the last budget. So basically, broadly, I'm saying interest rates get cut, interest rate sensitives pick up. That creates the funding environment required for your capex cycle, infra cycle, which a lot of fund managers have been talking about. So that whole scenario gets created once you get rates down and you have a stable government. So what are we really looking at then? Then we are looking at a market that can, move up much higher, equally to the type of rallies we've seen last year. And that can set us up for, 26,000 Nifty by the year end. So that is what I'm thinking. If the rate cycle kicks in, the government already there, heading to 26,000 by year end should not be difficult.
Okay, so 26,000 by year end. I guess, guys, that's what I was trying to understand. That contrary to all the gloom and doom that was playing out yesterday, could we actually be in for a much stronger second half than what we've seen so far this calendar year?
Okay, and 26,000 is about a 15% upside from the current levels. So that's fairly significant. We've already done 5%. Throw in another 15%.
But what within, Rohit, what will take it up? Interest rate sensitives, financials, banks?
Yeah, those in the front, because you've seen only PSU banks participate. You haven't seen big moves in the private banks, the NBFCs, all that entire space. So I think all of that starts doing well. And then when we say interest rate sensitives, then we're talking autos, which are doing very well today. Reality kicks in. And then you got the infrastructure and, capital goods has already been a performer, but infra stocks will also come to the forefront. So you have an entire gamut, I think, of space. And what you're also seeing recently, at least in the last month, is this rotation back into some of the, earlier growth areas. One of them, of course, being FMCG, which is in limelight. But FMCG started to outperform only, I think, early part of this month, well before the election result. The only thing the focus till the elections has been too much on PSU, which is why it probably got ignored. But on a 1 month basis, FMCG has been an outperforming, segment. And I will not be surprised that even IT makes a comeback, because globally the tech sector is, being started to do well. And the domestic IT sector is still under quite some pressure for quite a while. So you get that also. So apart from, areas where probably stocks have gone up too much, where you have valuations without growth, those are the ones that will really get pulled down, I think, in this rotation. But you are going back from, last year's entire rally, you can say, was a value rally, right? Growth to value, which is why PSUs came to forefront, dividend yield stocks and so on. Now you'll go shift back to the growth areas, right? So wherever there's going to be growth, that's going to get re-rated again. Let's put it that way.
Okay, Rohit, it's great conversation as always. Punchy. Thank you very much. 26,000 by the end of the